Okay, hello traders. Thank you for joining me for today's webinar. My name is Ali, I'm VP of Market Analysis and Education. I would like to welcome you to this session where we are going to discuss the best time frame for trading, which I think is among the very interesting questions between traders, because anyone wishes to find the best time frame, and today we are gonna to discuss it in a very great detail. I would like to mention that don't take any of the material that we are providing during our webinars as an investment advice or let's say trading signal or something like that. All the examples and all the material and the information that we are providing during our webinars are solely for educational purposes, and trading could be very risky and depends on your risk appetite, your capital, your experience, and many more. So but the good point is that we are trying to get you to that a level of experience and knowledge that you can trade on your own if you are a newbie or you have joined the financial markets recently, because with actually right tools and guidance, as mentioned here in my presentation, anyone can learn to successfully trade. So becoming a successful trader doesn't have anything to a luck or chance. It just needs to consistently practice and increasing your knowledge and leverage actually your knowledge by put attention on the education. So after this short introduction, let's just jump through our agenda for today. Today we are going to find out which time frame is suitable for which types of traders. So I'm going to share some information and some details about types of trading styles, also types of charts, and then we will go through different categories of time frame, and at the end of this webinar I hope you will be able to decide which type of time frame will suit you. Depends on your trading style and trading strategies. During this session we have an open Q&A. You can just send your question as soon as they arise and I will get to answer them as fast as possible. Okay, great. Okay, there are various types of trading styles and strategies. They vary based on the different risk appetite, for example, and amount of money of the capital that you want to put in the market, accepted time for holding a position open. For example, you may want to actually have a position open only for some minutes or maybe for a couple of weeks or months. And also the profits expectations is among another factors when it comes to choose a trading style. And last but not least is a personality and mindset of traders. Based on your personality, you may rather to for example stay with a fast-paced market movements, or you want to have a less stressful trading setups on a longer actually period of time. So traders use different strategies regarding their point of interest, and as mentioned here. So you may target each of which here, for example, you may target to follow your risk appetite as a low actually risk trader or high risk trader, or you may prefer to set your trading style and strategies and everything based on your time, your available time during the day, or maybe regarding your mindset, you wish to have your trades as close as soon as possible to close them, and or you may consider a capital only. For example, you have a very massive amount of capital, and so you think, okay, where can I invest my capital, or where can I put my capital and maybe have a hobby as a trading to with a fraction of my amount of money I can trade them. So you can take into consideration each of these factors to choose your trading style. But there are various types of trading style and strategies that varies based on all of these factors. But regarding the common features of all different strategies, we can break down Forex trading style into 4 common groups, which are day trading, position trading, swing trading, and scalping. it's worth to mention that many traders use different styles regarding the market situation and the risk management rules. However, before being able to choose a preferable time frame, it's important to decide what style may fit your trade setup. So that's why we need to review these styles prior to choosing suitable time frame. Let's start with day trading. Day trading, as its name suggests, is a method of opening and closing positions in the same day, which means trader, for example, you and me, doesn't hold any position overnight. Traditionally, professional traders and mostly technical traders follow this method. It means we want to open today and we want to close today at the same day. If you want to open and close a position within the same day, you may project your profit target not too far from your entry, or let's say usually you may consider short or medium pivot levels, which can be a reliable support or resistance as your take profit level. This trading style usually associates with an average risk because you have a proper time to keep along with the market, which you will see why in a minute. Because if you are going to manage all your trades in one day, you should use intraday time frames like 1 hour or 4 hour times to get a better depiction of the price charts with greater details. In that case, you will have some time to watch the market analyze and make your decisions based on the live market movements. So it actually associates with the average risk appetite because it gives you a proper time, and you can use the intraday time frames, which we call it the day trading. And the next one is position trading or trend trading, which is also described as a buy and hold strategy. You might have heard in the stock market, many people are approaching this style. In this style, trader tries to identify the general direction of the market, and if we seek that, we know from the technical analysis that the general direction of the market is implied by the direction of tops and bottoms. So when there are successive higher tops and higher bottoms, it means we are in an uptrend, and a position trader wishes to open a buy position in the same direction of the market, and vice versa for downtrends. For example, when we see a successive lower tops and lower bottoms, we can identify the general direction of the market as a downtrend. So as a position trader or trend trader, we are just going to open a sell position regardless of the level of the price at that specific moment. So the important point is that this trading style is followed for long-term moves, and trend traders usually keep their positions open for a couple of days because they are looking for a very high profit targets. This style associates a low risk, but it needs a considerable amount of capital to meet the required margin, because don't forget that you are going to trade in a Forex market, on leverage market, and you need to have always the required margin in your account. And the next trading style is swing trading. The swing trading or reversal trading explains a method that traders use to typically identify the beginning of a new trend. We know that at the reversal points, we see the market break through a significant support or resistance levels in the opposite direction of the prior trend, and this is where a place that the swing traders back to their keyboards trying to open a new position in the opposite direction of the trend. So the good point of this style is that you can manage to take an average risk, because this style gives you more flexibility in trading. You can use different time frames, and you can just manage your take profit levels based on the time frame and your actual profit expectations, also your risk reward ratios and risk management rules. So it's preferable to trade. You can choose among different time frames. For example, you can find reversals in 30-minute time frames, or in 1 hour time frames, or even in daily time frames. But the thing is that it's preferable to trade in 30 minutes and longer time frames, because you will see why how we actually categorize these time frames at the end of this webinar. And the last but not least is scalping. Scalping is very popular trading method or trading style among traders. Is a trading style that involves identifying very small price changes in the Forex market and then buying and selling high volumes of currency over a very short periods. So we are looking for only teeny profit targets. By repeating this strategy over time, scalpers aim to build up a series of little gains that add up to the decent day's profit. To seek very tiny price movement, you should be very fast in trading. This is a point, and this is one reason of high risk nature of scalping. Also, in this style, we usually use time frames less than 15 minutes. We know that markets can be very choppy in shorter time frames like 1 minute, which makes trading more riskier. So this style is recommended only for experienced traders who are skillful in trading a fast-paced environment. But before we move forward, let me show you some example to make it more clear for you. For example, I hope you can see my MetaTrader here. Yes, guys? Okay, great. So this is my MetaTrader 4. As we mentioned, for example, what is a day trading? The day trading is the method that I'm coming to lower time frames, intraday time frames, preferably from 30 minutes to 4 minutes. As you see, MetaTrader has 9 time frames here. And then I'm trying to implement my strategy on the live chart to see if I can hunt a trading opportunity or not. Okay, so in that case, for example, I may see, let me go through another instrument to show you a better example. Maybe, for example, here we have the Nasdaq, okay, in the 1 hour chart, and you see this is a massive fall down toward this supports level, and then we have this market bottom here, which is a higher bottom than the previous one, and you may want to trade this setup, okay, during the 30 minutes to 4 hour charts. Why we are choosing these time frames? Because we wish to close our position during the same day. For example, I'm going to open a position here, or for example, a position, if I open a position, for example, here, then I may wish medium target of price. For example, if I use my Fibonacci retracement levels and expansions levels, I may seek towards the 161.8% Fibonacci level, which I think till the end of today, the market may reach this level. So this is the day trading. So choosing between the intraday time frames, preferably from 30 minutes to 4 hours. And the next one, as I mentioned, is a swing trading, or let's go with the position trading. The position trading is that types of trades. For example, let's say I'm putting the 100 period exponential moving average on my chart, okay? And I'm going through, for example, what is this? It's EuroCAD on daily chart. What are you seeing here, guys? Yes, right. I see a pure downtrend. You know, for example, on weekly chart, I can see the price is far below the 100 moving average, exponential moving average, and also I can just draw this descending trend line here, somewhere here, and I see the price is, for example, at this level far away from the trend line. Okay, here's the thing, that when I see this setup on daily, I may wait for the price, for example, to get back to my moving average, 100 moving average here, and then I am going to open a sell position because I see the long term, the price has a long downtrend here on the monthly, on the weekly and daily. And that means I'm going to open my position here, for example, when I see a rebound from the moving average as a reliable resistance level during this downtrend, and then I'm gonna leave it for maybe a couple of days or a couple of months, because I think, okay, you're gonna depreciate against the Canadian dollar regarding the market situation, and this is a very common trading way among the fundamental analysts. They are trying to assess the historic value of an asset, and then they are going to see if it's overvalued or it's undervalued, and they decide to buy or sell that asset. For example, here you may think, okay, euro is going to keep depreciation against the Canadian dollar. So if the price hits this level, I'm going to sell the market, and then I will leave it for a couple of days. Or in this actually trading strategies, that it's not very common in forex trading, because you have a swap cost. Also, this is a leverage market. You're going to use your leverage, and that would be very risky for you because of your margin and the market fluctuations and everything. By the way, in this level, you can go for the daily, weekly, or monthly time frames. The next one, as I mentioned, I guess, was the swing trading. And a very, very good example of the swing trading was the Nasdaq 100 over the 30-minute time frame, or let's say the 1 hour time frame. Okay, swing trading is waiting for the market to change direction. And how we can identify that? We can use the various technical analysis tools and the theories to find out if there is a reliable reversal here or not. For example, you can use the chart patterns like what you are seeing here. This is a very famous reverse failure swing pattern, when we see the market is bottoming here and then making a higher actually bottom afterward, and then breaking above our previous top during a downtrend, which I mentioned as a breakthrough resistance level or support level in the opposite direction of the prior trend, which means here, because during the downtrend we don't expect the resistances to be broken. But here, as we see this breakout, we can consider it as a failure swing, as a complete failure swing actually setup, a reverse failure swing or bullish failure swing setup, and then we can just go through open a buy position here maybe. And you can use the swing trading in a variable time frames. For example, doesn't matter, let me show you a very great example of the euro USD. For example, here, if I can find the instrument, yeah, it's here. Yeah, for example, on a weekly chart, you can see a very beautiful double top pattern here formed on the weekly chart. So if you are a swing trader, it means you are waiting only for reversals. It means you have no limit. You can go through the different time frames, and at the end of the webinar I'm going to tell you which time frame has what features and advantages or limitations. So it means, and also as you saw, you can find a reversal on the lower time frames like the 30 minutes. But the last but not least way that we discussed about was the scalping. Scalping is a very, very common trading strategy or trading style among the experienced traders who don't want to wait a lot to make money in financial markets. Okay, and scalping means getting a tiny profit during a very, very small price fluctuation in the market. What does it mean? It means, for example, if I go through a 1 minute chart, and it's very recommended to actually use scalping strategies on the major currency pairs like GBP USD and Euro USD and likewise. For example, here I may see, okay, this is a candlestick pattern that we are going to discuss it, and then okay, this is the market is going back maybe through this level. So boom, at that level the scalper is going to open a trade at this level with a stop loss here and maybe a take profit somewhere like here. Yeah, the 1/1 risk to reward ratio. And what does it mean? It means you have to be very fast and you have to be really experienced to take these actually trading setups from the market. And also it is very risky because in the lower time frames we have a lot of noise during the market action. So it's not a very stable market sentiment. It's going to change at the moment, at the second. So you have to face the risk of scalping. But the thing is that the scalping is a very fast way for actually trading, and you can scalp on a very short-term time frames like 1 minute, 5 minutes, and 15 minutes. So you can first think about your trading style. Which of these 4 trading styles you think may suit you? You can revise your strategy, review your strategy, trading strategy, and think which one will suit you. And then the next step is to get more familiar with the types of charts, because when it comes to trade, we really want to know a little bit details even about the market fluctuation. So we are looking for as much as possible details on the chart. Okay, so and we have 3 different types of charts that they have their own unique actually usage. So we are going to review them here. Charts are one of the primary tools in trading for sure. Yeah, okay. And a price chart shows a set of prices plotted over certain periods, such as monthly, daily, or even 1 minute time frame. Traders use different chart types to understand market action and identify trends. So price charting involves several techniques and tools designed to gauge market psychology. So the aim of price charting, or let's say the charting methods, is to discover or identify the market psychology eventually. And the most popular chart types are as you see here, line chart, bar chart, and candlestick charts. And we know actual charts help us to get the better picture that can reveal information we need for our trading setups. But let's see what is each one. And the simplest chart type is a line chart, okay, which offers a straight line connecting closing prices over a given period of time. When you use, for example, 1 hour chart, each dot comes from the close price at the end of 1 hour session, and by connecting to them you can have your 1 hour chart, line chart actually. And despite revealing literal information, line charts help to understand the market's general direction, especially in the long term. As you see in the MT4 here is the place that you can choose between the 3 different chart types. And if you click on the line chart, you see the market just shows you the close prices connected to each other during this with this straight line, and you can see that each dot here represents the close price of each 1 minute. And when you use the 1 hour, it means each dot here is going to representing the close price of a 1 hour session. So this is the line chart. So that's why you see the different shapes in different time frames, because they come from the different close prices from the different actually trading sessions. Okay, cool. Let's move forward. Another popular chart type is the bar chart, and each bar is composed of 1 vertical line and 2 horizontal ticks, as you can see in the picture of my presentation. There are 4 major price points on bar charts, so they're called OHLC charts, okay, because O is for open, H for high, L for low, and C for close. And each bar's high and low represent the highest and lowest prices during a session. When you look at 30-minute chart, for example, the length of the bar shows the range of price movement in 30 minutes. And the left-hand thick, as you may see here, for example, if you look at this long red bar here, you see the 2 thick at the right side and the left side. The first one is at the left side. The left-hand thick on the chart shows the opening price for the session, which means when you are looking at the 1 hour chart, this is between 10 and 11. It means this is a price of the market at the 10 o'clock. Okay, and then prices actually move to this high during this session, and then back to this low, and then they closed at 11 here. This actually the tick on the right represents the last price or close price or the price of the 11 between the 10 and 11 trading session. We call the 10 to 11, we call it a trading session, and we call this length of actually bar the session range between the 10 and 11. So you can understand how much price fluctuated between 10 and 11 trading session. And the next one that we have Japanese candlestick charts, which are one of the most popular leading indicators. A candlestick is made of a body and two shadows, and the body represents the difference between the opening price. As you can see here, this is a body, or this blue one is the body, which actually represents the difference between the opening price and closing price for each trading session, while the shadows or wicks mark the distance between the highest and lowest prices of that session from the body, called the upper shadow, as you see here, or the lower shadow as the one you can see here. And the difference between high and low is called the price range. Okay, and it means in 1 hour time frame in candlestick for 10 to 11 indicates the open price at 10. For example, you see the market is opened here, okay, at 10 and close at 11. But during the 10 to 11, to catch this level, the market has fluctuated to this high and then back down to this low, the lower shadow, and then you see that price closed just at the 11 at this level. So this body comes in red when the close price is lower than the open price, and it comes in blue, or let's say green, or the hollow when we have the open price, and here I mean we have the close price higher than the open price, which means a blue candlestick shows that price is opened here at the first of this session, and then during the session fluctuated between this range that the shadows are representing, and then eventually the price closed at this level, which means the buyers actually could overcome the sellers and push prices higher to this level at the end of the session. And this is the candlestick charts. And if you wish to choose a right time frame, you have to know how to use and how to read charts first. For example, how much information you can extract from these candlestick charts. That's the important point, because it's all about your trading strategy. And then you have to after choosing your trading style, you have to get familiar with the different chart types to be able to actually develop your own trading strategy. And after doing that, it comes to types of time frames. As I mentioned before, here is a fun part actually, to see which time frame is suits you. And you can see 9 different time frame in MT4 or MetaTrader 4, and we can categorize them to 3 groups. Very short-term time frames. This is this first shape here, and this includes those equal or less than 30 minutes, which are 1 minute, 5 minutes, 15 minutes, and 30 minutes in the MT4, because on the different trading platforms you may find at different times. For example, 1 minute, 2 minutes, even 5 seconds. But the point is that the market action in these time frames is very fast. So price fluctuations can be surprisingly high, as they reveal a very sensitive sentiment of the buyers and sellers. So you can say they are very risky, but the price range is usually low. I mean, for example, when you look at the 1 minute time frame, it means all the high and lows and range that you are seeing on the chart, all of them just actually represent the session of 1 minute. So it might be not that it might not be that reliable, if you see, for example, what you can see on the daily chart, because as we go forward, we have the short-term time frames, longer than 30 minutes and less than daily time frames are considered short-term time frames, which reveal more stable and long-lasting sentiment and direction of the market. So this is a very common or let's say very popular time frame among traders to use a 30 minutes to 4 hour time frames, because the information that you get from the 4 hour chart are relied on the 4 hour market action. It means half a session of a day as usual. It means you can just see it as a more long-lasting market sentiment, and you can seek maybe your profit targets on a higher levels. Okay, and finally, long-term time frames includes time frames longer than 1 day, such as weekly and monthly. They shows the general and long-term direction of the market, and each candle or bar includes a wide range of volatility and price changes are significant. For example, when you look at the daily time frame, each candlestick represents the volatility and the range of the market, also the sentiment of the market during a day. Here you have the open price from the starting of today on Friday, and here is the last current price, which means you can consider the whole market action and the confronting the buyers and sellers during the whole day. For example, we are getting to the actually afternoon and the market is going to get closed. So, but when you look at the 1 minute chart, you see the last actually candle is revealing the 1 minute market sentiment, and you see why it is changing very fast. So if you don't like to trade in choppy markets and you don't like to take a lot of risk, you can rely on the shorter time frames between 31 hour and 4 hour. But if you are a very risky trader, you are a very skillful trader, and you have a very fast implemented strategy that you can just jump on the chart and by click of on the bottom, you can just open your position and close it. You may consider to trade in the lower time frames. But the thing is that, for example, here, let's say you see how price is changing during this session. For example, here, the length of the body shows the fluctuation or the sentiment of that session in a 1 minute session, 1, 2, 3, 4, 5, 6 actually minutes before. We have the 7 pips only on this 1 minute time frame. But if you look at the 4 hour chart, in the last session of 4 hour chart, which actually represents the trading market action actually between 8 to 12 of today's, based on the Cyprus GMT plus 3 actually time, you see the market has changed 138 pips, which means it's a very, very volatile session. So the price movement in higher time frames is getting higher. Okay, so you have to expect a higher. It means to trade on higher time frames, you need more capital in your account, because you may be able to take, let's say, 9 pips, but the thing is that you may not be able to take these 144 pips during a day. Okay, so you need more capital in your trading account. Also, you have to be a patient trader to get your profit targets eventually, because you see the market is fluctuating and each candle represents a very, very high volatility. For example, a day that the market just got back to, in an opposite direction, it moved 117 pips. You may scare, if you are not very confident about your trading. For example, let's say I open a sell position here around this candlestick, and then after this a pure down run, I see the market just gets back in this way. So that would be scary for me. So this is the thing that you have to really consider when it comes to choose your time frame. So as a conclusion, yeah, thank you, Mr. Ali, Asad Ali from Pakistan, joining us. Thank you so much. It's great to have you in this session. Okay, to conclude our session, first you need to decide about your trading style, as I explained, and then you have to get knowing the chart styles and chart types, and to see what kind of information you need for your trading strategy, and then which chart type can provide you with those information. And then you have to be aware of the different features of the time frame as I described. I hope you find this session informative and enjoy it. Thank you so much, and have a great trading day. Bye bye.